Good morning, everyone. Thank you for joining us today. Uh, we're going to be talking about fixed income investing as part of our finesse branding. And today, what we thought we'd get into is how people end up making mistakes in fixed income. Because the question that often gets asked is, what do I need to do right? Or what is the best investment to make today? But we thought we'd learn from a legendary equity investor to improve our fixed income investing. So here's Charlie Munger's inversion framework. And we're going to apply that to fixed income investing by studying a little bit about the past and seeing what has happened before and how we can work towards a future that doesn't have these mistakes. Because sometimes problems need to be solved in reverse, right? And let me kind of start this webinar and explain what I mean by sometimes problems need to be solved in reverse. Uh, Many of you would have been forced to study algebra when you were school. You may or may not have liked it, but this was definitely a part of your life, right? Um, so when you try to solve a formula like this, what tends to happen is you will realize that somewhere along the line, you are looking at trying to find x. Now, the way that you can do it is you can keep applying different numbers to x and seeing if that gives you a valid solution, which is, let's say I put x as 1, then 2 into 1 square plus 12. That does not give me 44. So I know that the answer is not 1. Then I can plug in 2, right? This is like trying to say, okay, what is the right thing for me to do? And you keep assigning values to x. Now, clearly, this is not a very easy to solve equation. And when you realize that probably you need to solve this backwards, right? You need to isolate x, you need to forget about the solution, and then you'll arrive at something. And this is something that most of us do automatically when it comes to algebra. And one of the greatest thinkers in this field, Jacobi, had this saying, which was invert, always invert. So sometimes when we're trying to solve problems, we don't need to solve them forwards. We need to solve them backwards, right? And this applies to investing as much as it applies to any other discipline in the world. And we look at how Munger uh, viewed this concept of inversion and how he applied inversion to investing. So, one of his famous quotes is, "Tell me where I'm going to die. That is so I don't go there." Right? So, if you want to avoid death, the simplest thing to do is instead of trying to do the 100 things right, you just figure out one element, right? That is where I'm going to die. And if I'm never in that place, then I'm never going to die. Now, this is a very interesting way of looking at how we need to structure our investments, particularly when it comes to fixed income, because actually in fixed income, mistakes can mean death, right? They can spell a permanent loss of capital, and it can be quite devastating to recover from that kind of investment mistake. So, why are we saying that fixed income mistakes are death? The basic thing is one, returns hit a ceiling in fixed income. And what I mean by this is, let's say you're looking at a very safe investment on the fixed income space, like a government security. Your returns are somewhere around 7.5%. If you move from central government securities to state government securities, you might go to maybe 7.5, 7.7. That's the kind of return. Then if you move to public sector undertakings and banks, maybe you'll get a little bit more than that, right? Then if you start moving down the quality ladder and you look at credit or corporate bonds with low ratings, then your returns may go to 9.5, 10%. And then if you go into the junk category, right, you can make more money. But the point is, at some level in fixed income, you will hit a return ceiling, right? And that means that you're not going to go beyond a certain percentage. You can't have like a 10 bagger or a 100 bagger on fixed income, which is possible in equity. But mostly none of us know in advance where you're going to get that extra return from on the equity side. So here you're capped. You are promised a certain return, and that's all that you get when it comes to fixed income. So the returns are basically, the nature is that it is non-compensating. So that essentially means that whatever your return is, uh, you're not, if you make a bad investment, you're not going to have a good investment that makes up for the bad investment, right? You're just going to have a good investment, and you're going to have something that you've lost. And in fixed income, there is a permanent loss of capital because you are basically lending capital, and the borrower is promising to pay you interest as well as that money back, right? So if you make a mistake, and if you choose the wrong investment, or if you choose an investment that defaults, then the risk of you getting that money back is much higher. um, yes, you are first in line when it comes to insolvency, but your returns are also capped. You're not going to make a lot. So here you need to understand that there needs to be a lot of precision in the way that we're making allocation decisions. There needs to be a lot of security in what we are choosing, right? There's no point in taking on an additional dose of risk because the additional dose of return is not really matching up or keeping pace. So this is something that we need to keep in mind whenever we're thinking about how we want to approach fixed income investing. So it's always had this reputation that fixed income investing is easy because after all, you just need to look at returns, you just need to look at how long your timeline is, and if it matches, that's great. But it's actually not as easy as we think it is, right? Simply because so many things have happened just in the last 5 to 10 years in the markets. So if we look at some of these events, right? There was a categorization and classification of mutual funds. Before that happened, there was a lot of chaos for investors because you would have something like a short-term fund, and then one AMC would be running it in a particular way, another AMC would be running it in a different way, and you would have two funds within the same category that were very different in style and approach, right? Or you could have a corporate bond fund which said that you had this whole thing of some funds would be high quality with only AAA bonds, some funds will be high credit with higher yield. So the past performance data of the fund with the higher credit risk would be bigger than the one with the higher quality portfolio. So this thing of comparison was actually very difficult. Then SEBI stepped in and came up with a clearer categorization structure, and today it's a lot more friendly for an investor to be able to understand what goes into each category, right? Then you've had some really big events in terms of uh, these well-known companies, well-established track records, with possibly like a triple A rating that have defaulted in the past. You had an instance where a mutual fund had to shut down schemes during the COVID pandemic. You had taxation changes. You had bonds from issued by banks being written off, right? So these are all things that have happened in the past, and that just brings to our attention that fixed income investing need not be easy. We shouldn't take it lightly, and we shouldn't assume that it's going to be an easy journey for anybody. So when we understand this, we can start looking at what the framework actually tells us. And there are 5 important things for an investor to know today when it comes to the mistakes that we're going to make. So how can an investor get it wrong today? Right? What is it that they can do to mess up? Once we understand this, we can figure out what we can do right, and that will give us a framework for decision making. So the number one mistake is not allocating to fixed income. Why is this a mistake? Now, many investors in the last few years have become used to regular returns from uh, equities. They're used to a steady growth trajectory. They're used to higher levels of returns. So today, when they look at a 7% return from fixed income, it doesn't seem attractive at all. But what is behind the 7%? Right? It's not just about what it's giving you today. It's about what else is in that particular investment. So one, when you look at fixed income, it's an easier asset class to get in and get out of. And what that means is it's great for liquidity, it's great for asset allocation, and it's a great way even for an aggressive investor to take a breather, book some profits, and come back into the markets at the right time, right? So, not allocating to fixed income can be detrimental for an aggressive investor. It can also be detrimental for a conservative investor simply because they've not seen down cycles, right? So, if by nature you're conservative, but you've changed your asset allocation in the last 5 years to more growth oriented investments, to more equities, it's time for you to take a step back and look at restructuring your asset allocation. So that's the number one mistake that we can make in the markets today. Now, the second mistake is that you don't have a vision for your portfolio. So if you have no portfolio vision, what does that actually mean? It means that you don't know how you want to allocate your capital. You don't know what your assets are doing for you. And you don't know why you've invested in different assets or what is the end goal that you're tying to. So what you need to do when it comes to fixed income is to have some broader vision, right? What am I trying to achieve with a particular investment? Am I trying to generate income? In which case, I might want to look at a bond that pays regular interest payments, or I might want to look at a fixed deposit with a monthly income option, or I might want to look at something like a systematic withdrawal plan. So that is one objective, right? The second is you want to look at capital appreciation. So if you're doing that, the best avenue today is to look at a mutual fund scheme because your capital grows in a fairly tax efficient way in the sense that you're not paying for that growth. Whereas if you're in the deposit space, you are going to be paying tax on that year on year, right? The third is whether you're looking at managing opportunity costs, and this is oriented towards more aggressive investors. Now, if you want to make sure that you're protecting your investments through a phase of volatility, and May has been a fairly volatile month, right? This switch from equity into fixed income and then back into equity needs to happen in a phased manner. So, this is a way for you to manage your opportunity costs. And the last is basically to stabilize portfolio returns. So if you feel that I don't want such a bumpy journey, right? I want some level of predictability. My equity can go up and down, but I want my fixed income to be more stable. And I want to have overall cushion my portfolio returns. This is a great way for you to do this. And we're in the right point in the market cycle also to participate in fixed income. So this is what it means to have a portfolio vision. And without a portfolio vision, what tends to happen is we choose the wrong products, we create the wrong expectations from the products that we invest in. And because we're expecting the wrong things, we end up being disappointed. And this is avoidable if you just spend some time in structuring your portfolio vision, in selecting products that help you meet these particular objectives, and in planning what you want to do with your overall portfolio and how your portfolio is going to work for you. It's not just about you putting this effort into structuring your portfolio. At the end of the day, it has to work for you as well. So now we look at the third mistake, which is what I like to call do nothing investing. Now, a large portion of fixed income investors are passive because the products that have been available till date have been relatively passive, right? If you sign up for a fixed deposit, then you're locked in for a few years. There's no need for you to really change what you're doing. Your deposit will continue to pay you interest, or or that interest will accumulate, and then on maturity, that is what you have. Um, and then you had bonds, and the market has been fairly liquid, so it's not like you can enter and exit as frequently as you would like to. But uh, today, I think what we need to understand is that at different points in the market cycle, different opportunities crop up. And if we choose to do nothing, right, then we're actually missing out on what we can do. So, as the yields change, so do your opportunities. And this is just some data of the 10-year government security between December and May, December 2022 and May 2024. So if you really see how this is going, you'll see that broadly we've been in the range of 7 to 7.5%. But at different points in time, you had opportunities, right? So when you're closer to 7%, you don't want to take duration calls. You might want to be in shorter term. When you're closer to 7.5%, you might want to actually start taking duration calls. Uh, so this kind of movement, understanding where we are in the interest rate cycle, understanding how bond markets respond to different news or data points, right? Specifically, things like inflation, central bank commentary, fiscal deficits, elections, all of this influences bond yields. And when the yields change, so do our opportunities. And we need to be prepared to take the right opportunity at the right time. We also need to be prepared to layer our decisions, which is that today, if you want to invest say 30% of your portfolio in fixed income, over a period of time, what is the best option for you will actually keep changing. And you need to adapt to that change. You need to layer your portfolio. You need to participate in whatever the most attractive opportunity is at a given point in time. So, keeping this in mind and not following such a static approach to fixed income investing is the third way we can overcome the mistake. So now we'll talk about chasing returns, which is the fourth uh, investment mistake that you can have. And to illustrate this, I'm just going to talk about a few things that we have witnessed in the past, right? So during this phase of say 2017 to 2019, credit risk funds were very, very popular, right? And then you had the ILNFS crisis, you had COVID. Only then did the risk off sentiment really start. And even then, you didn't really have a broad based exit from credit risk because the yields were better. And the logic was that after the ILNFS and DHFL default, they were like, oh, what does it matter? The credit rating is just something that gets said. Even AAA companies can default. So, how does it matter if I'm in lower uh, grade credit? But credit and the interest rate cycle are very important. Credit is very sensitive to economic changes, and that's the hard reality. And it's difficult to predict what is going to happen when. All of us really, I don't think anybody really expected COVID to be the kind of disease that it was, or to have the kind of effects that it had on the economy. Even if we go back and look at what people were saying during the early phases of the lockdown, we were way off on a lot of things. People said that we would never get off from wearing masks. That's clearly not true. I think anywhere we go today, that's not something that we're experiencing. So the reason people wanted credit risk funds was not because that it made sense in a fundamental manner. It was because you had good performance in that particular category. And that good performance actually came from taking a much higher level of risk. And at some point in the market cycle, that higher level of risk was not warranted, right? But that was not the only case. You've seen this in multiple other scenarios as well. There was a phase during an equity bull market where certain mutual funds were able to uh, churn out a monthly dividend. And this happened for a prolonged period of time. So investors kept thinking that, oh, like I'm making 10, 12% on my investment because I'm getting a 1% payout in terms of monthly dividends from this portfolio. And at that point, I think dividend income was also not taxed the way it is today. So this was an assured thing, right? But actually, there was nothing assured about it. It was sustainable because the markets kept moving up, and through that, there was some profit booking. And the thing that was coming as dividend was not just profits, right? It was actually capital gains that were coming back. I mean, it was capital plus gains that were coming back to the investor. So, again, when we chase returns, the thing is, we don't really deconstruct where this return is coming from and how it is generated and whether it makes sense or not. Similarly, there was a tax arbitrage that was available to market linked debentures. or MLDs. So they were taxed like equity instruments, but it was a bond. And so many fixed income investors flocked to that particular category, only to realize that taxation changes are really not in their control. And and you can't take it for granted, right? Any tax loophole that you find, it's going to get plugged eventually. Um, so that's another thing that we need to keep in mind. There are some factors that are completely out of our investment control, and there are some factors that are within our investment control, and that's why we need to focus our time and energy. And the last theme that I had picked from recent history is target maturity funds in 2020. So when you had the ILNFS or the NBFC crisis that happened, what happened to markets in general was that yields spiked through the roof, right? So you had AAA bonds trading at 9% at one point. And this was basically because the markets were scared. Uh, and you see this in every cycle, whether it's equity, whether it's fixed income, whether it's gold. When there is fear, there will be a sudden price hike or a sudden sell off, depending on whether the fear is towards that particular asset class or away from it. So, when you had this massive sell off in fixed income, even the best quality bonds and the best quality funds took a big hit, right? And so, for those 2 to 3 years, you had great performance. So, that first year was painful for investors. But following that, the next couple of years, you had great performance. And then you had COVID. And during COVID, you had these multiple rate cuts that occurred. So you had MTM gains as well. So now with target maturity funds, what happened was you had a period where you had a high quality portfolio. Pretty much every factor worked in favor of the fund, and the returns were great. And these became from being very unpopular funds during the NBFC crisis to the best performing, highly rated funds at the start of the pandemic. But that was not the right time. 2020 was not the right time to implement a target maturity strategy. And I'll show you that in charts, right? So if we look at the target maturity performance from 2018 to 2020, right? You had a 9% compounded return on that particular uh, portfolio. And if you look at target maturity performance from 2021, right, which is basically the time when products started rolling out, because through most of 2020, there was still a very high risk off sentiment in fixed income. And if we look at the same 1.5 year period, you'll notice that in the return was only 3%, right? So what went wrong? You need to pay attention to cycles. The same thing cannot work all the time. Some things work very well in specific situations. So target maturity worked extremely well in 2018 because you wanted a high quality portfolio that could roll down. You were buying bonds at 9% yield, right? And then you had some basic level of MTM gain appreciation that came through rate cuts. Now in 2021, you were already at a very low interest rate, which meant that your interest rates were only going to move up. And if you had a passive structure like a target maturity fund, you are not really going to make money from that, simply because you're not capturing the newer opportunities. We saw about how the yields can be volatile, right? And when yields keep changing, you want to be able to participate. So 2021 to 2022 was a period where you needed to be more active, you needed to take more active calls. Whereas 2018 to 2020 was not that kind of phase. 2018 to 2020 was a kind of phase where you could just be calm and follow a simple strategy. So we need to know what is the right thing to do at the right time, and we cannot measure that by chasing the returns that have appeared till date. We have to look at what will work in the next cycle. So with that, I'm going to move on to our last mistake or part of our inversion framework, which is something that we've heard as a proverb, right? Don't judge a book by its cover. So if we keep judging a book by its cover, and this has happened in the fixed income market so many times, that it actually needs to be said, and we need to have a conversation about this. So you shouldn't be judging a book by its cover simply because when we have done this in the past, we've looked at AAA ratings. So you had DHFL, you had IRNFS, all with great credit ratings. Right now, why did this even become an issue? It's because of the nature in which ratings were given. So ratings are issued by a credit rating agency, and that's typically for a new issue in debt. So when a borrower comes to the market, they need to get their debt rated. They don't need to get their debt rated afterwards. So there's no recurring rating or maintenance rating that happens. It's only on the initial issue that you have this credit rating, right? So if somebody is not coming to market and their balance sheet strength is decreasing over a period of time, they're still going to have the old rating, but the old rating may not actually be applicable. If you have a very complicated entity structure as well, it's possible to have selectively good ratings, like certain sub entities may have the best ratings, but the parent may actually have a lot of other problems that are also going on. So the nature of the corporate structure matters just as much as the credit rating for that particular security. So we need to look beyond just the entity that is, let's say we have a bond from company ABC, and the parent is PQR. We need to look at both ABC and PQR. We can't treat them as independent entities, especially if PQR is giving corporate guarantees to all of its subsidiaries, right? Um, then uh, we look at fixed deposits, right? So typically, when you have a bank fixed deposit, that is 100% safe. You've never really had an issue where a bank has defaulted, and there are lots of regulations for scheduled commercial banks that the RBI has in place. But what we need to understand is other things that call themselves banks are not under the same regulatory framework, and investors don't have the same level of protection. So if you have, we have seen also that you had PMC Bank, which is a cooperative bank, right? And their fixed deposits, they did default on the interest payment. There was a long period in which investors had to wait to get their capital back. There were huge lines. So it's not that you can take these things for granted. And again, here, the thing that drove investors there was just the higher rate of return, right? So we need to be very careful when we're chasing returns in fixed income. And the last thing is perpetual bonds. Here, because they were issued by banks, people assumed that they were just like fixed deposits and that there would not be any default. But we saw this happen with Yes Bank, we saw this happen with Lakshmi Vilas Bank, and even after it happened with Yes Bank, you had people still participating in these perpetual bonds from LVB, etc. Now, the fixed deposit investors in both of these cases got completely honored. But the perpetual bonds clearly say, right, that there is no need to pay back the interest. Like if they skip a particular year, there is no need to compensate in another year. And that there is no timeline in which the capital has to be repaid, which is that the bank has like a call date, but they can extend the call date to whatever date they want. So this is where we stand as far as the framework is concerned. And with that, I'd like to sort of quickly go over our framework of what all we've learned today. And I think the first is that we need to create an asset allocation strategy. So there are like six elements to this, right? So knowing your asset allocation strategy, participating in fixed income is one important thing. Then characterizing your objectives to select products. So what tends to happen is investors will first select the product and say that, oh, you know, this bond is there, it's giving me this return, I want to buy it, without actually knowing why they're making that investment. So start with what you want to achieve. Do you want a stream of income? Do you just want a high interest investment? Do you want something else? What is the actual goal here, right? Then you need to carry reasonable expectations. So once you know why, you know what product you're choosing, and you know what to expect from that product. And if your expectations are in line with your objectives, you're not likely to deviate from your plan, and you're not likely to be disappointed or chase returns. right? The next thing is continuous participation, which is what we talked about, right? As the yields change, so will your opportunities. And today we're in a market where you have more products. It's not just bonds and deposits. You have mutual funds, you have ETFs, and these are all different things that can fit into your fixed income allocations. And instead of chasing returns, we need to change our mindset and start chasing opportunities. So, trying to understand where is the opportunity today? How do we invest in a manner that is safe and at the same time helps me reach whatever my goal is? And the last is to basically conduct your due diligence. After all, you are lending money to somebody. If a friend or a relative or somebody's like someone else in your network asked you for money, you would think twice, right, about giving it to them. You would make some effort to understand why they need it, how they're going to use it, whether they'll pay you back before you did that. But when it comes to investing in fixed income, somehow we are not used to applying that same rigor, and we need to do that to take things to the next level. So this is just what we do in Finesse. We have a monthly outlook, and you can subscribe to that as a newsletter. We have webinars like the one that we've conducted today. We help investors who work on the milestones to wealth as well as the ithought MFT program with product selection. We do investment reviews also if required, and we also help you after product selection. Of course, you have portfolio construction as well in terms of helping you decide how to allocate your investments to meet your financial goals. Uh, and I'd also like to spend a couple of minutes talking about the Milestones to Wealth program. Our promise is basically to help investors get from wherever they are to their first crore. And this journey is a long journey. And in this, what we are committed to doing is to handhold you and guide you through this whole process. There is a lot of learning and teaching both ways. We learn from our investors in the program, and we're also able to share knowledge like how we've done today in the webinar. And then we're able to coach and mentor you through this journey to 1 crore. And there's a continuous measurement process, right? Where with each milestone, we're able to assess, okay, when can we hit the next milestone? What do we need to do to stretch to achieve that milestone a little bit earlier? So it's a good uh, program. And if you work with us through this, what is the outcome for you? You will be able to inculcate financial discipline. You will be able to create a growth mindset, which basically means that you expand your capabilities, you believe in yourself, you're able to do more. You slowly build investment conviction. So you understand how market cycles work, you understand how investments work, you're able to may take that into your advantage. You'll also get a wealth map, which is basically a journey that tells you, okay, at this level, we need to prioritize these actions. At the next milestone, we need to prioritize these actions. And then there's, of course, scalability, which means that as you cross milestones, the more and more will happen for you. So this is a really great way to interact. It's a great way for you to focus on your own wealth creation journey. And it doesn't matter where you are today. Our commitment is to work with every investor wherever they are. So with that, I'll open up for questions. So I think there are some things in the chat. I'll just start uh, answering whatever has come here. Okay. So the first question is past then defaults can happen again? Because what we hear is a lot of cleaning had happened in the last few years, but there is still some skeletons in the closet. See, defaults can happen at any point, right? Because if we think about how this works, we start with um, an idea that people are very cautious when it comes to lending. Then they lend to the best people. They start making more returns. Then they become a little bit more complacent, and because they stop prioritizing risk management so much, then they get into lower quality investments. Then defaults happen. Then as the defaults happen, then you become more risk averse, and then you become more stringent. So we've seen this in every cycle it happens, right? So if I look at the last cycle, after the ILNFS crisis, you had the bank balance sheet cleanup, you had all of these norms come in, you had NPA reporting, and then you saw this thing where banks stopped lending so much to corporates, right? So it became harder for corporates to raise money through the banking channels, and instead the banks focused on growing the uh, personal loan book. Then the RBI stepped in this year, and they said that no, 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 we're going to start regulating this, and that was a proactive measure. So that is good regulatory intervention, right? Because you've not actually had a problem like a ILNFS crisis, and most of us are not going to remember this because nothing big or bad happened, right? But essentially nothing big or bad happened because there was timely intervention. Now that needs to keep happening. Of course, you can't be sure that always the regulator or the lenders are going to be so proactive in managing risks. But you can be hopeful, or you can try to assess quality on your own side, right? And see who has best practices. It requires some level of research. It's not easy to judge that, right? Okay. So the next comment is now most chase returns and run behind equity with hardly any focus or even interest in debt fixed income. Too much euphoria and overhyped to equity. Only a single most sought after asset class. Yes, I think to a certain extent that is true, because what you are saying is that people have had a very good experience in the equity markets, right? And many of us have not really experienced a down cycle because you had a very brief down period in 2020 when the lockdown happened. And markets were cooling in 2019, but because of the pandemic and the lockdown and everything, that kind of uh, faded away, right, from recent memory. And then you had many people enter the market between 2020 and today. And with this new entrance, they have experienced only one direction in the market, which is not really how it works, right? You're going to have an up cycle, you're going to have a down cycle. So people who've never experienced a down cycle, we don't know how they'll respond to that. They may be able to take it in their stride and continue to participate and layer their investments. But mostly what we've seen in past cycles is that's not how people behave. When that first wave hits, and if it's a rough one, or if it's multiple difficult waves, then people kind of tend to stay away from the markets. And that exit tends to be for many years together. It's not that 1 or 2 years they'll be out and after that they'll come back. So that's something we'll have to wait and see. Okay. Also, most experts say it's always better to be in shorter debt cycle like liquid short-term funds rather than long duration. Uh, I think long duration can be played at specific points in the cycle. So when you're nearer to the peak of interest rates, you can play a duration call, but you need to be careful with your entry and exit, right? And you need to be tracking that cycle and factors closely to be able to do that. But if you're in short term or liquid, or if you're in the lower duration space, then yes, you can be there at the top of the cycle, you can be there at the bottom of the cycle. You don't really have too much to lose. Yes, but see, the thing with indexation being taken off and all of that is that, like I mentioned, taxation is not in your control, right? Next year, if the finance ministry comes and says that they want to change equity taxation, there's nothing that you can do about it. Your asset allocation decisions, of course, you must be tax conscious. There's no need to, choose the most tax inefficient investment just because it's available to you. But at the same time, you should not move out of an asset class altogether because it's not as tax efficient as it used to be. Assets have a specific role in our portfolio, and it's not only tax saving. There are other uh, benefits of having an asset allocation. How would you rate rates and InvITs? Would you put them in the same basket as fixed income given the perpetuity nature of the product? So, rates are basically, I think it works for a very niche set of investors because it's actually an income oriented product more than anything else. Like, yes, there is underlying real estate exposure, but the idea is that whatever income is made has to be distributed to the investors regularly. So it's not a growth oriented product. So that is what I would think. So obviously, I'm sure there is one category of investors who would like real estate exposure plus a uh, but regular but not fixed stream of income, right? Because that's the nature of the real estate investment class. With InvITs, again, some of them are good, but you need to really study it, and it's a very long, like you rightly pointed out, it's a very long term product. So how much you want to lock into that is again a question that you'll have to take. Okay. From YouTube channel, Ben Graham suggests that aggressive investors to invest in high grade bonds and not low quality bonds for better returns, as the risk reward is not favorable, and to focus on stocks for better returns. Yeah, that is a great way to approach it, right? You decide to take your risk in a different asset class, and you decide to take your safety in fixed income. That is also the way that we would approach it, because, like I mentioned at the start, there is a return ceiling. So why do you want to take on more risk when the more return is only going to be 0.5% or 1%, right? It doesn't make sense beyond a point. So we need to be careful about where we want to take risk. To summarize this presentation, what message would you give investors? Prioritize safety when it comes to fixed income. That's all. Uh, be safe in your investments, be conservative. That will work very well. If there is no concept of re-rating, how can we get the real rating of an institution when we want to invest in bonds? So ideally, one is you could stick to shorter term bonds so that there isn't like too much of uh, an issue. The second is you can look at somebody with a longer track record, a cleaner balance sheet, fewer sub-entity structures. Um, you can study the underlying business. So right now, if somebody wants to invest in bonds, a lot of them are actually from non-banking financial companies, right? So if you're in the NBFC space, many of them are listed. You can understand how that industry is working, what part of the cycle there is. So even from the equity side of things, you can get insights on how the balance sheet is being managed. So there are other ways. You don't see, the rating is only one element in this whole process, right? It's not the entire thing. Like, you cannot make a decision based on the rating. Similar to how, let's say, if you're going to look at a mutual fund investment today, the star rating is only one element that you're going to consider. It cannot be the beginning and the end of your research. There has to be more work that goes into it. Okay. What percentage of our portfolio in fixed income will the return beat inflation and taxation? So again, the percentage actually depends on your risk profile, your situation, and what you want as an asset allocation, right? So the asset allocation is again determined by your target return. And one is like, you can have a broader level asset allocation, but let's say at specific points in time, you might have to adjust or deviate from that asset allocation just because the market or the cycle has changed in a particular way. Could you explain more about the target maturity fund and how it works? Yes, of course. So target maturity funds are basically, if I say I have a 2027 fund, that means my portfolio will mature sometime in 2027. And then the idea is that if I hold 10 bonds today and they pay me interest next year, then in 2025, I will buy a bond that will again mature in 2027 with that interest or whatever additional income that I have. So this is the way it works. So every new bond that I buy will be of a shorter maturity than the original bond. So ideally, my whole portfolio will reset in 2027. So that is the way it works. So now your ETFs are basically, they will mature and close uh, when the target maturity date is reached. I hope that clarifies it. If not, I can explain it again. Uh, as far as our products on the M2W side, um, we do basically mutual funds, and if you're with ithought MFD as well, that would be the main thing. But we also have some corporate deposits and some bonds that you can invest in. So these are the products. We have a wealth map in terms of how we can help you plan your overall finances and do some goal mapping for your investments. And we'll continuously work with investors to explain what is available, what is a good investment to make today, how we want to approach the market, etc. Thank you, sir. I think your words are very encouraging. We do like to engage with investors, and we'll always have something happening every Saturday. Your participation means a lot to us. What is your opinion about FMP? What is the return that we could expect? FMPs are good in the sense that they are a fixed maturity plan, right? So you will know it's kind of like an FD, but in mutual funds. So you know what the maturity date is. The returns are slightly more predictable than an open ended mutual fund simply because there is no unexpected or mark to market element that's going to change things too much. Uh, at the same time, like it depends on what your use is. Like if you have an FMP and it is aligning with a goal, it makes sense. If you prefer more predictable returns and you want it through the mutual fund route, I think then also the FMP makes sense. But if you want a continue, like if you don't want this forced maturity, right? Because some people come and they say that I have a 3 year horizon, but maybe I won't take the money out. Then I think it makes sense to look at an open-ended scheme. Uh, because after the fund matures, you will get the proceeds, and again, you'll have to decide where to invest. No, I don't think there's a minimum on the M2W program. There are a couple of questions in the Q&A as well. Let me just get through them. Okay. I think it's already done. It was the target maturity. Thank you everyone for attending. If there are more questions, Gopi, do we have anything from YouTube? We don't have a specific product for debt. What we do have is Finesse, which is basically like a service where we work with investors on their fixed income allocations. So that can be across because ideally, what tends to happen is some people need deposits, some people need bonds, some people need mutual funds. So for each person, that is customized. It's not a single product that we have. Thank you, sir. Gopi, nothing from YouTube? Okay. So, if we don't have any questions, then I would like to thank everyone for coming today and asking a lot and making this a very interesting conversation. I hope to see you next month. We'll be doing something then as well. And in between, if you ever want to reach out to us, these are our contact details. So you can drop us a message at 9677000613, and we'll be happy to take it forward and help you with whatever you need. The recording will be available on YouTube, sir. It'll get published over the weekend. I think inverts also don't give you a fixed return in the sense it's a distributable surplus, and the fixed part comes from the repayment of principal. But if you find a good quality invert, then you can see if it is suiting your needs. Because from what I understand, it's not again very liquid, so you have to have that mentality to hold to maturity, just like how we have that with bonds. Okay. Right. Thank you, everyone.